Ryan, it's great to have you with us today. I was reading your note, and am I reading this correctly? You are seeing some of the best values in busted SPACs. Which ones?
Well, first off, to your earlier point, given the fact that we're 13, 14, 15 months into this real tech bear market where a lot of those smaller speculative names and a lot of these SPACs are the ones that took a majority of the damage. And then only until November did it start to infect the rest of the market. And then really only in the last 4 or 5 weeks have we seen that kind of move up to the larger cap names. And in a lot of ways, if we are in a bottoming process, which we think we are, we'll look back in a lot of ways, this will be kind of a textbook kind of bear market, the way it plays out. As for the SPACs, obviously we saw a lot of companies come public last year that really had only not much more than a business plan. But through that mix, there were actually a few companies that we think are legitimate long-term buys here.
Okay, which ones are those, Ryan? And how do you determine which ones are from that SPAC wreckage?
There's a handful, 2 that stand out. Probably the largest is Cvent. This was a company that we owned back in 2015-16, was acquired, taken private by Vista. They came out in a SPAC format last year. You may ask, for a company that's that mature, they lead the event management space and technology. They were hurt, obviously, during COVID. There weren't a lot of live events. They had to transition to a hybrid model for the events that they were hosting, and then a virtual model. And the results were so poor, they really didn't have that traditional IPO route to go. They had to give these longer forecasts that were allowed during SPACs to show people as the economy went back to normal that their results, should benefit. And we're starting to see that already.
Ryan, the Elon Musk Twitter process has been confusing to a lot of people, but you've been pretty nimble in managing it so far in this process. Talk about what your playbook's been.
Well, Twitter's been a large position for us for a while. We've always felt that it's been underappreciated and undervalued, given their global reach as a social media company. Obviously, they've been unsuccessful in kind of figuring out exactly how to monetize the subscriber base well. And so then when Elon Musk made the investment, we thought that was an interesting move. And then when we did think that there was a decent chance he would end up trying to acquire the company. And then once that happened, the stock went over $50. We basically felt the risk reward wasn't that positive, given there could be some bumps along the way. And quite frankly, also because we saw some, looking as an opportunity to redeploy. I think now that the stock is back into the mid-30s, it's really, at this point, the risk reward is skewing the other way. We still have a little Twitter position. We're actually considering adding to it. We do think the deal will eventually go through, even if it comes in at a smaller discount to the 54.20.
Right, but you're not betting on a drawn-out legal process.
There could be. But we're talking months, not years. So, it's still, this is going to be, in essence, an all-cash deal. We would expect a fairly quick close once, we get through some of these legal issues. It's always a possibility. I think it's well more than discounted in where the stock is today. I'm not sure the stock would fall a whole lot from current levels, maybe another 10 or 20%, even if Elon were to walk away.